Hi there everyone, it's Jason here again, and today's masterclass we're going to cover the journal. Now the journal is an area which often does slip up students, but it's a fairly easy area. It's just important to remember that the journal itself is not part of the double entry system. It's very much a sort of diary, if you like, to record transactions. Now I'm sure you remember from previous studies that we've got books of original entry. And by that, I could mean cash book or sales day book, purchases day book, returns inwards day book, returns outwards day book. So the journal, I guess, is for transactions that cannot be entered into any of those books of original entry. So I'm going to demonstrate with 3 transactions in a second, and I'm going to sort of show you why they can't be entered in the books that I've just mentioned, and so why in that case we need a place to enter them. So basically the other items that don't pass through the 5 books I've just mentioned are actually sort of far less common, I suppose, and sometimes they're much more complicated. And I guess it would be easier for a bookkeeper to forget the details of these transactions if they were made directly into the ledger accounts from the source documents. And obviously, if something like the bookkeeper left the business, it would be impossible to understand such bookkeeping entries. So what we need, therefore, is some form of diary to record such transactions before the entries are made in the double entry accounts. And this book is called the journal, and that's what we're going to show you today. So it is very important to remember that the journal is not part of the double entry system. It's basically a sort of form of diary, really, just like the day books that I mentioned before. Entering an item in the journal is not the same as recording an item in the double entry account. Once the journal entry is made, the entry in the double entry accounts can then be made. It's literally just to record information. So, as I said, if you came across the example that I've just talked about, whereby, for example, a bookkeeper left the business, then all these transactions that are not cash sales or should go in the sales daybook or in the returns daybook, these transactions can be retraced back to the source documents via the journal. So what we're going to do is going to go through 3 transactions, if you like, and I'm going to show you basically how they were recorded in the journal, and then sort of tell you how they're posted in the double entry accounts. I'm not going to show you because I'm not covering T accounts or double entry in the session. I'm just covering the journal. So what we'll do first of all is just explain briefly how the journal is written up. So if you look at the sort of this top part of the screen here, we've got the first column as the date, we've got the second column as the details, third column as the folio. So this is where, for example, a reference can go. And then we've got our usual debit and credit columns. So the first line in the journal is always the account to be debited. That's the first thing that goes into the journal. So just literally the name of the account. The second thing that goes in there is the name of the account to be credited. Now, you'll notice that it is indented. Now, that's quite important. It's always commonplace in the journal, I guess, to indent the credit entry. And it's just to separate out things, to make things a little bit clearer so you can see which accounts are debited and which accounts are credited. And then lastly, we've got the narrative, which we use an explanation, if you like, as to what's actually happened in this transaction. And then we've got the folio column, where, as I say, we enter a reference, and we've got debit and credit, which is our normal accounts. So what we're going to do is just look at 3 transactions that we need to use the journal for. So the first transaction I've got is a milling machine is bought on credit from Toolmakers Limited for £10,550 on 1st of July 2008. Now, this is not an ordinary purchase, so it therefore does not go in the purchase daybook. It's a purchase of a fixed asset. The purchase daybook is very much for exactly that, for purchases that we've made. So we're going to enter this transaction in the journal before it gets posted in the double entry accounts. So we've got 2008 there, as you can see. We've got the date as July the 1st, and we've first of all got the account to be debited. So we've got the milling machine bought on credit from Toolmakers for £10,550. So we're increasing a fixed asset, so that's a debit, so that's what goes in the debit column. So we've got the name of the account, machinery. Next column, we've got the folio reference, so this is just a reference to trace it back to the ledgers, if you like. In this case, we've got GL1, and then we've got our debit amount of £10,550. And we've bought this machine on credit from Toolmakers Limited. So Toolmakers is a liability. We're increasing a liability, which is a credit. So the credit entry, as you'll see, is indented slightly. and we've got the folio reference there, PL55, and we've got the credit amount of £10,550. So that's the narrative of the double entry. I was going to say that's the double entry, but it doesn't mean the double entry is completed once we've done the journal. Once we've done the journal and we're happy with it, we then go and post it into the double entry accounts. And as you'll see underneath here, I've got a little narrative: purchase of milling machine on credit, purchase invoice number 7/159. So if the journal, if the sort of the diary of the journal is picked up by another bookkeeper in the future, this transaction that's in the accounts can be traced back. We can trace it right back to the journal, and we can trace it back to the purchase invoice because we've used that as a reference on the journal. So you can see why it's a sort of stopgap for everything that doesn't go in the books of original entry that I mentioned earlier. So we're going to do another transaction now on July the 2nd, 08, and it's a sale of van no longer required for £800 on credit to K Lamb on the 2nd of July. So we've got our date here, we've got the 2nd of July. So it's a sale of van no longer required on credit to K Lamb. So K Lamb will become a debtor of the business. Now, a debtor is an asset. We're increasing an asset, so that's a debit. So K Lamb, the debtor account, is the account that we debit. And I've got the folio reference there as SL79, and I've got the debit amount of £800. So K Lamb's account will be debited by £800. And so the transaction is the sale of van no longer required. The van's a fixed asset, but it's leaving the business. So we're decreasing a fixed asset, which is a credit. Remember, increasing a fixed asset, which was the transaction above, is a debit. So by definition, crediting a fixed asset account should be a credit. So we've got K Lamb in the details on the debit side for SL79 folio reference for £800 debit. And we've got an indented entry there, as you'll see, for the credit entry, GL51 reference, and we've got a credit of £800. And then we've got the narrative, the sale of van no longer required. And we can put another reference in there, C letter reference KL3X8G. So again, this transaction, although it would not fall into a book of original entry that I mentioned before, the reason we have the journal is because this sort of transaction can be recorded and we can trace it back. So in this case, we can look at that letter reference and we can sort of trace the transaction back to the source document, if you like. But we have to have the journal, we have to have this part of the accounting system completed so that a future bookkeeper or another member of the business can look at the journal and trace that transaction back. So I'm just going to do one more transaction here. It's a bad debt transaction. So we're going to say what's happened in the business on August the 31st, 08. A debt of £78 owing to us from H. Mander is written off as a bad debt. Okay, so H. Mander was previously a debtor. Now, if you remember, as a transaction above, we increase a debtor is a debit. So therefore, decreasing a debtor should be a credit. So we know that the credit entry should be a credit. So by definition, the bad debts account should be a debit. So we need to debit the bad debts account. Again, a reference of GL16 with £78. And H. Mander, that's in the sales ledger, previously a debit balance on the debtor account. We're now indenting the entry, as you can see, because this is a credit. We're going to credit H. Mander's account using the reference SL99 for £78. And the narrative we've got there, we've got debt written off as bad, C letter in file HM2X8. So I'm sure you can see those three transactions that I've just demonstrated. We've got a purchase of a fixed asset, we've got a sale of a fixed asset, and we've got a bad debt written off. So that's three examples of transactions that would not fall in the books of original entry that I mentioned earlier. Let's say the cash book, the sales day book, the purchases day book, the returns inwards day book, and the returns outwards day book. So if a transaction does not fall into any of those books of original entry, we have to have the journal. The journal is the other book of original entry that fits in with all the others. And as I say, it's very important for me to hit home that the journal itself is not part of the double entry system. It's merely a sort of diary method of recording transactions that happen in the business that can't be recorded anywhere else. And once they're written in the journal, they can then be posted to the relevant double entry accounts. So that's it. So short and sweet masterclass this week. As you know, I do like to do these masterclasses in bite-sized chunks. So I'm going to leave it there for today. Hopefully that's made sense. But please, if you have any questions on the journal at all, or anything else relating to this session, then please do post your comments or questions or queries as a comment on the Facebook post that this falls under. We've got a YouTube link, as you can see, which is where you're watching the video from, obviously. But if you do have any questions or queries, then just post them as a comment below, and I'll do my best to answer them as quickly as I can. But that's hopefully covered the journal for you. That's hopefully made a bit more sense of what it actually is. I think, as I say, the point to make is that the journal itself is merely similar to the sales day book or the returns inwards day book. It's not part of the double entry system. It's a book of original entry, and it's used to record transactions before they're posted into the double entry system. So hopefully that makes sense. Hope you've enjoyed the session. That's the journal covered for the latest masterclass, and we will see you all again soon. Thanks very much.